What's up, traders? Chosen Trades back here with another insightful video. I hope you all had a great week in the markets. Today I'll be going over intraday bias and how I was able to secure 4% during ICT'S New York Hill Zone. Without further ado, let's get into it. Alright, anytime I'm looking to see what the market is doing, I start with my analysis on higher time frame. So the weekly, the daily, and the 4 hour. In this case, with my style being a mix of intraday and scalping, I still did my higher time frame analysis on the weekly and daily time frame. However, my main focus was looking at the 4 hour and 1 hour, as that would be the framework on how to enter on lower time frame. Looking at the 4 hour, I can clearly see that the market is extremely bearish. So we can see here, the market is extremely bearish. We see a lot of sell side delivery that's moving aggressively to the downside. From here, the market structure shift moving down. Then we have a retracement. Then price moves down even more aggressively. Comes back, corrects a bit. Then moves down even aggressively. So I was highly anticipating this strong liquidity to be tapped into. And we can see this was a trade that I took that ultimately showed proof of that. And that's also something I'll be going more in depth in this video, such as my entry, my thought process throughout the trade, what I learned after the trade, and everything else in between. We can also clearly see here that price is showing no signs of bullishness. Market structure is also another confluence that price is extremely bearish. So we get first a structure shift, then we get a lower low, then we get a correction, or even a correction here, lower high, breaks lower, lower low, corrects up even more. Lower high, breaks below, lower low, and then I was anticipating a lower high around this area on lower time frame. That's where I ended up getting my entry at, and then ultimately tapping into the draw liquidity and getting a lower low. For just visual purposes, you can see lower low, lower high, lower low, lower high, lower low, lower high. Low. This is clear bearish market structure. You also may be asking, why this price level? Why a draw liquidity at 1.08249? The reason for this is because it sticks out on the chart simply. You can see that prices just continue to head lower, and this is a level that price hasn't tapped into. Same with here as well. Actually, price did tap into this relative equal lows, but this was something that I was looking as a price point for price to tap into, and we've got just that. Price has yet to purge liquidity to sell side delivery for orders to be activated, while I am also allowing the algorithm to continue in its intended direction. Once price taps into 1.08249, this allows price to have a balanced price range. So then the balanced price range is that allows the market to correct itself and then continue in intended direction. So anytime price taps into an area of liquidity, price will then correct just to fill back those orders that were not traded into and then correct it. Anytime price taps into an area of liquidity, you'll see that usually price will then correct, going to fill any imbalances that were not traded into and then continue its intended direction. That ultimately is the definition of a balanced price range. It just fills areas of liquidity, imbalances, and then continues in its intended direction, to simply put it. Now, with the benefit of hindsight, we can see that price then retraces, as I mentioned, to fill back any imbalance and rebound before heading lower. And I just want to give you guys an example of ICT teaching how price is meant to have imbalances, and then the algorithm would then rebalance, providing buying and selling opportunities for traders. He uses the analogy of you're painting a roll it back and forth with the paint roller. So let me drop to lower time frame to kind of give you more of a clear example. With this example of the trade that I took, we can simply see that price created a market structure shift. And with the market structure shift, we see an area of imbalance, meaning an area where prices has an imbalance and there's an efficiency level as well. So in this case, this would be a SIBI, sell side imbalance, because price is delivering sell side. It's inefficient, providing buy side opportunity for sellers to continue lower. So the analogy he uses is that when you're painting a wall and you roll it back and forth with the paint roller, there's going to be some pockets or areas on the wall the paint did not fully distribute to the wall. You would then have to roll it back down to cover those pockets of missing paint. The same ideology applies to the fair value gap entry model. So like I was saying, price trades back into an old fair value gap. In order to know that this is a valid setup, you need a break of structure at this short-term low in this case, because we're looking for sell setups. And we see that price indeed does the break of structure and creates that market structure shift. Now we have a quote-unquote pocket or area on the wall where paint didn't fully distribute. market in the price chart. So that we eat, or we're patiently waiting for price to trade back into it and then continues in the intended direction, which it does here. So that's as simply as I can put it for the fair value gap entry model. My entry came off the 3-minute time frame, so there was an obvious SIBI, sell side imbalance, buy side inefficiency. That price needed to rebalance and continue heading lower. Price ran up to the imbalance ran up at 7:51 a.m. Eastern time. It showed signs of weakness with the candle rejection, so we can see here price rejected well, leaving this wick. And this was one of my confluences to enter the market when price is showing volume exhaustion on the candle. This ultimately allowed me to think that price has a willingness to move lower. Price then began to move lower from the SIBI, and then ran back into the SIBI around 8:19, 8:18. So this was also another opportunity to sell in the market. If you didn't get in here, definitely could have gotten here at a better entry. Price at times can do a second tap into the fair value gap to induce retail style traders to think price is securely moving in the opposite direction. So sometimes you'll see price will tap in, go lower, and people will think, oh, it's running. So then they'll probably chase the move here, probably get crushed if they go here. Yeah, people think, oh, it tapped into this area. Oh, this is the actual fair value gap. I'll mark it up in a different color for you guys. Yeah, they'll be thinking, oh, this is the real fair value, this is the real move. So then people actually start to buy here when they see this move, this aggressive move up, especially with this candle. Think, oh, buying opportunities, not knowing that it's only to wipe them out and use their stops as additional liquidity to move the market in its intended direction. So usually when you have your narrative formed and you have an idea of the liquidity, you want to patiently just wait. When price does tap in and drops, it may do a second tap, so you could definitely get another entry here and then allow price to continue to move lower or higher based on price action. So when price does its first tap, drops lower and does a second tap, that's another opportunity for you to get in. Price usually does that just to induce traders to think that price is going in that opposite direction, when really it's just to get an additional liquidity have been moved the market even lower, in this case for the sell side. So for me, my entry came in at 1.08700, just at the start of this bearish candle. During the trade, I found myself confident to trade as I trusted my analysis and the confluence on intraday time frame. Seeing that the 4 hours was extremely bearish, it would be shocking to see price reverse and begin its bullish momentum. Then again, price can do anything. Ultimately, I followed my trading plan, and this is what the setup called for. I did find myself becoming anxious when price did a second tap here at the fair value gap, just because I wasn't totally in sync with the markets. I seemed to have been a bit distracted on the charts and rushing to take the trade. I was slightly chasing this move. Could have got a better entry here if I maybe dropped down to the 1 minute. So let's look into the 1 minute. Look, if I dropped even lower, I could have sold right at the close of this candle right here, or even sold at the close of this candle. But I think because I was looking at the 3 minute, I didn't get that really minute printing of the charts, and I'm a big fan of the 1 minute chart. It allows me to really get sniper entries. That's something I can see that kind of threw off my game a bit. I could have even sold right here as well at the hard right edge of the market. That's when what you've been studying and practiced on demo all year shows in the live market. So that's something that I'll be focusing on to improve the craft. Let's go back to the 3 minute. Another reason I was a bit anxious was because of this aggressive move up, especially with this big candle. I thought price was going to do a stop and take this. But like I said, had I been more in sync with the market, I should have realized that once it did, it made a low. It ran up here, price went lower, even took out this low pretty much, at least the bodies of the candle. Because like ICT says, wicks do the damage, bodies tell the story. So this body is lower than this body. So having that in mind, I would have figured that this was going to continue going short. This lower high didn't take out this. It respected it, went lower, took out this lower low. So then it was simply going to just respect this high and then continue lower. But all in all, I still trusted the trade and stuck with my confluence, which influenced me to take the trade. In hindsight, I also seen that price was just simply inducing retail style traders to go long. This was really a fake out and you could say a mini manipulation, if you will, only for price to deliver sell side beautifully. So yeah, this trade went 1-4 and I was able to catch it. Yep, beautiful trade. In this trade, I learned that trusting my skill set is very important as a trader. I don't want to cause myself in the long run doubting myself and second guessing as to whether the trade I'm taking is valid. Being confident in myself and my ability is vital for longevity in the markets. So just trusting my trade, trusting my skill set, trusting that I've put in the work, countless hours, you know, the whole deal on learning the skill set. I have to trade, win, lose, or draw. I have to accept what the end result is. I also need to psychologically get over the hump of, you know, stacking entries, adding to my entries, because there were many, many opportunities for me. Despite my initial entry coming in here, I could have went short here, 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 could have went short here. So I mean, all great opportunities, and you know, it's beautiful that as a trader you're able to critique yourself and know what you did well and what you didn't do so well. And this is just me being transparent with you guys as far as what I'm looking at the charts and where, you know, I can grow. So that's really what this channel is about, just transparency, being honest with you guys, showing you that not every day is going to be a 10 RR trade or 20 RR trade. No, if you get your 2 RR trade, beautiful. Get 3, beautiful. 4, beautiful. You know, it's the simple things in trading that you want to do. Keep it simple in trading. You don't want to overcomplicate things and find yourself doing a lot just to leave with crumbs or not really be profitable in the markets. So ultimately, this was a great trade. I also find myself in one gem I want to share with you guys before ending this video is that fear can hinder the trader's growth because it doesn't allow you to be free flowing, accept whatever the market gives you. Your fear of losing or not getting in the trade can really be detrimental to your success as a trader. So I believe backtesting and simply taking that risk to add another entry will push my edge slightly. Granted, it doesn't jeopardize my account. In order for me to, you know, psychologically get over the hump to add an entry here, add an entry here, add an entry here, add an entry here, or even add an entry here and here, I would just simply need to take that risk or take that bold step like, hey, I've been studying the markets. I have a good idea of what's going on. I have to trust and know and think like a smart money trader and know that, hey, this was just simply a fake out just to wipe out retail sellers and kill their stops right here or even here. If they entered here, they're most likely leaving their stops below here. Just a way to kill their stops. Over time, my confidence will grow and will reflect on the charts with my performance. Alright, thank you guys for watching this video. If you found value in the video, please leave a like, comment, and most importantly, subscribe to the channel. Your support helps to grow the channel as we strive to help traders on their journey as well. Signing out. Chosen.